Welcome to another episode of Equity Mates on AusBiz. Great to be back for another week and our final week for 2021. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. It's strange that it's our final week for 2021 and it's just ticking into December.
That's great.
But you know, we get to set our own hours at AusBiz, I guess. So happy to take the extra leave.
Yes.
But look, it's an exciting week for us to finish on. We've loved bringing the long-form interview format to this show here at AusBiz, splitting it up over 4 episodes, but really getting the opportunity to go deep with a guest. And that's what we're going to do to close out in our final week. It's one of our favourite guests, a returning guest. We're joined this week by Roger Montgomery.
Yeah, that is right. It's our pleasure to welcome back Roger Montgomery, star performer for us here on AusBiz. So Roger, welcome.
Great to be with you both, guys.
So, Roger, we've got you for a week, which we're really excited about. As Ren said, we're going to cover everything and sort of neatly wrap up the year and what has been and think about what's coming next year. So, there's nothing more sort of timely than what is going on at the moment with inflation. So, if we start just generally, where do you currently sit on the inflation debate? What's your current view?
Yeah, so, it really will take a long time to unpack that question. The markets have a number of fears, and you've got to compare the fears to reality, but you've got to acknowledge that both a fear and a reality, both of them are capable of destabilizing markets. So even if the reality doesn't eventuate, if there's enough fear that it will, that can see volatility in markets. Having said that, though, let me talk about the short-term concerns the market has, and then I'll give you, a longer-term picture that I think is structural rather than cyclical. So what's happened recently since we last spoke is that US headline CPI at the end of October came in at 6.2% year-on-year growth. So that's far higher than what the US Federal Reserve predicted back in March. In March, they were assuming 2.1% for the calendar year. And more recently in September, they said that they expected about 4.2% inflation. Now, it came in much higher than both of those numbers. And so while Jerome Powell had previously explained that there would be a spike in inflation coincident with a recovery from the COVID-inspired recession, because it was much higher than what the Fed anticipated, the market investors and commentators started to fear that the US Federal Reserve was getting it wrong. They would have to imminently raise interest rates, and they would have to back off the accelerator, which is currently planted firmly on the floor for quantitative easing. So what's actually happened is the US Fed has eased back slightly on quantitative easing. So they were buying about $120 billion of US Treasuries a month, and they backed that off to about $105 billion. So it's about a 12-13% decline in bond purchases. But many commentators have come out and said, well, look, if inflation's at 6.2%, that simply means that they really have to stop all quantitative easing. They have to start jacking up rates. Rates should be much higher than where they are today. There should be no quantitative easing. And if they continue with this quantitative easing at current rates of inflation, they're going to inspire hyperinflation. That's just nonsense. Hyperinflation is 50% inflation per month. We're nowhere near that. And you only need to look at examples elsewhere in the world to see that hyperinflation isn't a concern. In fact, if you look at Japan, where Japan's quantitative easing in proportion to its economy is 4 times bigger than the US, and yet they're still flirting with deflation, and inflation isn't an issue. So I don't think that's a concern. I also believe Jerome Powell, when he said back in April, on the 28th of April this year, he said that inflation will spike, but because of base effects, we won't see a sustained acceleration of inflation. And what that base effect reference is a reference to the fact that we had price increases at zero during the depths of COVID-19 during the COVID-inspired lockdowns. And from that very low base, now it's at 6.2%. So, of course, if you start at a very low number, you get a very big jump, even with a small amount of inflation. But next year, if inflation rates, if inflation doesn't accelerate but decelerates, then what you're going to find when you're comparing next year's price increases to this year's price increases, it's going to be lower. And so you're going to have disinflation. Now, disinflation combined with economic growth is the perfect environment for growth stocks. It's the perfect environment for innovative companies. And it's also a very supportive environment for companies generating income, because all the fears of rising interest rates will turn into a celebration of declining interest rates or no interest rate increases. So that'll be incredibly supportive for the stock market. And then what we will return to, in my view, is we'll return to the structural theme or the structural narrative for inflation, which is low rates of inflation. And in fact, if you go back to 1979 in the US, when inflation was about 17%, ever since then, 13%, ever since then, it's been declining. And it's been declining for a couple of reasons. Number one, wage pressure has been falling. And the reason why wage pressure has been falling is, number one, we've had lower union membership in the workforce, both in Australia and in the United States. In fact, union membership in the US and in Australia today is probably 30% of what it was 3 decades ago or 4 decades ago. So that lowers wage pressures. And of course, in Australia in 1983, we had the Prices and Income Accord. That's where the unions and the government agreed. The unions wouldn't jack up wage claims every year in return for the government working on keeping prices low. And so the US and Australia have enjoyed lower wage growth and consequently lower inflation, and because we're not getting that wage price spiral. And the second reason is innovation. Now, innovation and technology advancement is exponential, and its influence on prices is equally exponential on the downside. And what technology does, technology like artificial intelligence, automation, information technology, all of those sorts of things, what that does is it lowers the cost of manufacturing, it lowers the cost of producing a product and delivering a service. And remember, when it comes to services, a very large portion of the cost of a service is income. And so a lot of people, when they talk about inflation, they don't talk about the income side of the equation. And so when you've got inflation in services, you have got rising wages there. So inflation is not a destabilizing influence on the quality of life for people. But more importantly, back to the question of wage pressures, the biggest innovation that we've had just in the last 10 years has been automation. And automation displaces labour. It removes jobs. And that's not a good thing necessarily long term, but it is good from an inflation perspective because it lowers wage increases. It puts downward pressure on wages because people are losing their jobs, not able to negotiate higher wages. And then finally, those people who talk about hyperinflation and worry about all those sorts of silly things, they often talk about the price of oil and how far oil's gone up without actually acknowledging that oil, or the economy today, is far less dependent on oil as an input component as it was back in the 70s and the 80s. So we're less reliant on oil now than we were in the past. So we really structurally do not have to worry about inflation, and we will revert to that structural theme pretty soon, I think, sometime next year.
I love it, Roger. A little bit of bullishness to end Equity Mates on AusBiz for 2021. Perfect recipe for growth stocks for 2022. People would love to hear that. I guess people would listen to you talk about the wage pressure and how wages have been coming down for the last few decades. And then they would look at a lot of the news coming out of the US, especially the increase in the minimum wage, companies really struggling to find labour and, continually increasing starting salaries to get people in the door, and think that maybe something has shifted in the last 6 months or so, and maybe there is wage pressure in the economy. How do you think about that? Do you think that's transitory,
Well,
yeah?
you're absolutely right. But it's a function of zero immigration. Soon as international borders open again, and we saw Scott Morrison on the weekend just talking about getting 200,000 people, skilled and unskilled migrants, back into Australia as soon as possible. We've also got 750,000 university students that would normally be in Australia that are overseas at the moment. They create about 250,000 jobs. So, yes, we do have pressure in the workforce at the moment, but it is temporary. And it's a function of the fact that our borders have been closed. Once those borders reopen, we will get that migration back, and that issue will be a non-issue.
So Roger, just to close out, thinking about how to position a portfolio, like, with, there's the bullish case that you've got, and then there's the bearish case that a lot of people have in terms of the impact of inflation over the next sort of year or so. So how are you actually thinking about positioning a portfolio, or perhaps what would you suggest to a beginner investor at a time like this?
Well, as I said right at the start of our conversation today, there are fears and there are realities. And just because the reality doesn't occur, it doesn't mean that the fear can't inspire volatility in markets. And so what we've been doing is taking advantage of companies that we think are going to do very well, either cyclically or structurally, when there's been price weakness because of fears of inflation. So it really is just being contrarian. We know the companies we want to own. We know the companies that are doing well. We know the companies that are going to do well. And all we're doing is taking advantage of lower prices because we believe, we're very confident in the idea that in the long run, the thematics are very, very supportive for equities.
It's a fascinating debate, and I love talking to you about it because you always have such strong opinions. So that is unfortunately all the time we have today, Roger, but we do have plenty more to discuss over the next few days. So we'll leave it there and we'll pick it back up tomorrow. Thanks for your time.
Looking forward to it.
And that brings us to the end of today's episode with Roger. We will be back tomorrow, so stick with us, and we look forward to seeing you same place, same time tomorrow.